Long-term capital management, the $4.6 billion collapse that nearly broke the financial system. 2 Nobel Prize winners. The most sophisticated financial models in modern finance. A hedge fund with $4.6 billion in capital, over $125 billion in borrowed money, more than $1 trillion in derivatives exposure. And in less than 6 weeks, the global financial system was close to collapse. This was not fraud. This was mathematics, leverage, and certainty. And it failed. How does a fund built by the smartest people in finance nearly break the system? In 1994, John Meriwether launched long-term capital management. He recruited Myron Scholes and Robert Merton, pioneers of modern financial theory and future Nobel Prize winners. Their edge was quantitative precision. They identified small pricing discrepancies between similar securities and bet that spreads would converge. Buy the undervalued asset. Short the overvalued one. Capture the difference. The spreads were tiny. To make real money, they used leverage. And at first it worked. Returns exceeded 40%. Banks competed to lend them capital. Confidence grew. Risk expanded. By 1998, LTCM had $4.6 billion in equity and over $125 billion in borrowed funds. Their derivatives exposure exceeded $1 trillion. In some positions, effective leverage approached 100 to 1. A 1% adverse move could erase equity, but their models treated extreme events as statistical improbabilities. They believed diversification reduced risk. The real danger was interconnectedness. Major banks were counterparties. Credit was extended across the system. No single institution saw total exposure. If LTCM failed abruptly, forced liquidation would cascade through global markets. This was a network of leverage embedded in the financial system. As confidence grew, LTCM expanded into emerging market debt, mortgage-backed securities, and volatility trades. On paper, it looked diversified. In reality, every position depended on stability. All trades assumed orderly markets and continuous liquidity. Markets are not equations. They are human systems. And humans panic. In August 1998, Russia defaulted on its government debt. Investors fled risk. Treasuries surged. Risk assets collapsed. Instead of converging, spreads widened violently. Positions moved sharply against LTCM. Loss multiplied. Because of leverage, small deviations became existential threats. Billions evaporated within weeks. Banks demanded more collateral. Margin calls intensified. LTCM attempted to unwind positions, but their trades were enormous. Selling into falling markets pushed prices further against them. Liquidity vanished. Other institutions held similar trades. Everyone tried to exit at once. There were no buyers. Models assumed continuous liquidity. Reality delivered sudden evaporation. This was no longer a hedge fund crisis. It was systemic risk. In September 1998, the Federal Reserve Bank of New York convened major financial institutions. The message was clear. If LTCM collapses chaotically, the damage spreads. 14 banks injected $3.6 billion in a coordinated rescue, not out of generosity, out of self-preservation. One fund with $4.6 billion in equity had nearly destabilized global finance. LTCM failed for structural reasons: over-reliance on historical data, underestimation of tail risk, illusion of liquidity, intellectual overconfidence. Their models were precise, but calibrated to calm periods. They assumed correlations would remain stable. Under stress, correlations converge. Diversification disappears. Precision in normal times creates fragility in extreme times. Long-term capital management did not collapse because they were foolish. They collapsed because they were certain. And in financial markets, certainty is often the most dangerous position of all.